Hello, folks. Welcome to Pro Trader Strategies. My name's Eric Wilkinson, and this is Spotting the Trade. I'm going to get you what you folks need to know before you roll, and that's going to be talking about the economic data, how that impacts the overall markets, throw in some market analysis, maybe sprinkle in a little geopolitical fodder to round that all off, and then talk about some option strategies we could implement into a portfolio based on these assumptions we come up with in the market analysis. All right, so without further ado, let's get on with the economic data. Yeah, sorry about the blue eyes I got going on today. Got a couple of lighting issues, but I'll work through those a little bit later today. Economic data. Yesterday, we were talking about the PMI, which is Purchasing Managers Index. These numbers have been coming out pretty decent. Anything above 50 is expansion in the economy. So that would lead us to believe, because this number is forward looking, these purchasing managers have a pretty good grasp as to the demand that they're seeing. Well, so we're seeing these PMI numbers do pretty good, but then all of a sudden on the flip side, I talked about this, we're seeing the manufacturing numbers come in a lot lower than expected, which is a bit of a disconnect here, folks. When we're seeing the Philly Fed, Philly Fed, Empire State, now we're getting Richmond Fed. All of these numbers are coming in lower than expected. The actual manufacturing numbers, we saw it come in at negative 0.9 yesterday, expected to be a positive 0.9. That was a little bit of the weakness that we were seeing in the market, putting a little bit of a dark cloud over it, when we're trying to rally off these really low lows on a basic 20%-ish correction off the highs. We would expect to start to see some support here, some folks coming in and buying. We're seeing a little bit of that, but these numbers are starting to make folks really wonder what's going on. New home sales, even those came off. Finally, 591,000, expected to be 750,000. They even revised last month's number down a little bit from 763 to 709. So big revision to the downside there. New home sales, the higher interest rates. We've talked about the position folks are in right now in dealing with interest rates, how if they want to buy a house, they can only afford a certain amount, right? You're budgeting for, your life, basically, your year, and you can spend so much on a car, so much on a house. Well, when interest rates rise, that means you're paying more from your budget to the interest of that home than you are the principal, which you're actually paying down the actual purchase price of that house. So with that said, a lot of levers and pulleys going on in the markets. With that said, real battle going on between the folks that think that we're kind of at a place where this is a buying opportunity. We're going to talk about this the next week or so, where our perspective has changed to a different paradigm that we might really have to start taking into account here in charting as well. Then we move into some of the data we got today. We got the core durable goods numbers. Remember, when we're looking at core durable goods, those are excluding transportation items. Durable goods are anything that lasts longer than a couple of years. We're talking like refrigerators, microwaves, things like that, big appliances. So core durable goods, stripping out transportation items, comes in at 0.3%, expected to be 0.5. Revision to last month's number by 0.3%. Maybe wipes out that front headline number a little bit, but I think people are going to focus on the downward trajectory these numbers are coming in at. Durable goods, when you add back in transportation, airplanes and cars, comes in at 0.4, expected to be 0.6. So a little bit light there at the revision, again, making up for that headline number, but I don't know if everybody is going to hang their hat on that. And we get crude oil inventories coming in, expected to be a drawdown. I wouldn't be too surprised to see a drawdown here because we have an increased supply, folks. So there's obviously still demand out there with manufacturing and folks like us driving around every day. So the markets, we got crude oil. Let's get a bigger chart of crude oil here. Crude oil still climbing, 111, holding on to the 110 handle. I would like to see this pull back a little bit, folks. I mean, I'm sure you guys are already tired of paying around $5 a gallon for gas when we were just last summer looking at like $2 and $2.50 in gas. So almost doubled what's coming out of our pocket going into the gas tank. All right. That other half of that money isn't being spent in the economy, folks, and it's really going to slow velocity of money being spent there. I can't really tell. I'm trying to tell if my camera off? That look okay to you guys? Please comment over there on the side. I know that my lighting is bad, but now all of a sudden I'm looking at the chart and it looks a little funky here on my other new screen here that I'm not real happy with. A lot of things rolling the wrong way today. All right, so we not with the markets, just with what I have with my setup here. All right, bonds, they're starting to climb again. We're hearing the Fed, especially folks talking out of Davos. Interest rates are going to continue to rise here at a pretty decent clip. Well, with that said, if interest rates are rising, we would expect to see the bonds go down, right? As we know that these products are inversely related. I'm trying to see if this will work. Oh yeah, we got it to work. All right, so let's get this thing going here. Just to talk about interest rates here. As bond prices now are rising. So when we talk about prices and interest rates, we can say the price is over here. We got interest rates over here, right? Well, if price is rising, we can look at it as a teeter-totter. That means that interest rates are going down. We're seeing that product happen right now. Interest rates are starting to come off. That's not what we're hearing the Fed start to say. What is this signaling? Well, down the road, the folks are starting to say, and I'm not too sure that the Fed has got their head wrapped all around this and not too concerned about higher interest rates for the longer term is what the markets are trying to tell us. Now, we have been seeing strength in the dollar over the past several months, maybe even close to a year now, where it's almost at parity with the British pound, 93 cents or something, but very close. One of the closest the closest we've been in a very, very long time. So that said, we could see some weakness being brought on to things like gold as strength in the dollar causes that to collapse a little bit. All right. Well, I'm not buying into that. This is an inflationary gauge and we're seeing inflation across the board. So why gold is not retaining that value is a little bit odd to me. I thought that once we got above this value area high and then even further got it into the 1900 handle, breaking the previous all-time high, that we were going to be off to the races for a little while. That was a very short-lived rally just during a little bit of a panic there. Just really surprised that we're not seeing gold make that rebound. I don't have a trade for gold, but it would be to the upside. Probably selling some options against it, maybe sell some puts because of that high volatility. It's at the point of control, so I wouldn't really want to play around with that too much. Bitcoin, folks, it's below 30,000, and below 30,000 in this type of environment is not giving me a whole lot of hope for a big upside pop here in Bitcoin, as folks are really just highly concerned about equities at this point. As you can see here, we have the equities on a downward spiral, and I do have this on a long-term chart here. So let's flip that over to a daily here. We can see breaking down to these lows. Now, I've been talking about this for quite some time that we were going to see that 11,250. Well, we've gotten very, very close to that, just about 240 away. I do think that that is a target. We might rebound away at this point, but we're continuing to see lower lows, lower highs. We're still in this bearish pattern, folks, and it hasn't been broken, despite the fact that some markets are starting to make it look like we've gotten a couple of confirmations off of the bottoms here. Now, this is where I was talking about we needed to be looking at this, starting to read the tea leaves as to whether or not we were going to get a confirmation on this bottoming pattern. Got the confirmation, just not really feeling the volume, everything else around this. Then yesterday, we get a bit of a topping one. So confirmation happening today, still in this bearish cycle. It'd be selling into rips. I've talked about this. We're looking at covered calls. Anytime the markets start to rally, we need to, with this high volatility, do some covered calls around our portfolio, lower our overall cost basis on these trades. That way, it's not so painful, folks, when the market starts coming off. You're making money on that downside. We've also talked about how with an overall portfolio, we can adjust the risk that we have in that portfolio. Generally, a lot of us are very long in our portfolio, right? We own stocks we love. Well, what do we do when the market starts to roll over? We don't want to take capital gains on some of these things. Like some of you folks probably own Tesla from $20 or something. Well, you don't want to take capital gains on that kind of trade. So how do you hedge that risk? One of them, best ways is to do some covered calls, lower overall cost basis, one of the lower risk types trades. Yeah, you could get into a capital gain situation there, but you have a very low risk profile there. The other thing we can do, and we're going to talk about this tomorrow in the webinar, cracking the code to trading options, folks, is the risk reversal. This is what institutional traders have used for since they've been trading options, is a risk reversal, which changes some of that risk perspective in your portfolio so that this downside moves when you get into a bearish move that you don't want to take capital gains on because your long-term perspective is still pretty good. Well, this is an opportunity to add that strategy like the risk reversal that we'll talk about tomorrow. We'll talk about the strike locations, how you set that all up, step by step, breaking it down from simple concepts to real life examples there. All right. The Dow Jones Industrial Average, while I've been touting it holding up a little bit better than the rest of the markets, there still is a line in the sand. 30,000 or 29,500 is the next step down. That is going to be the previous high there from, I think it went back to the high of, let's just take a look at it. I can't remember what I pinned this to right now, right off the top of my head, but to the top of the pandemic high. Pre-pandemic, I should say. And then we got the sell-off. So that's the measured move off of the pandemic. So while the Dow Jones didn't have that move to the upside, I don't think that we're going to see an exacerbated move to the downside so much because it is usually the store of value. But when we look at all these 3-year charts, you can see from the pandemic high, mini S&Ps, pandemic low, measured move to the upside. I also took another little chart here on a measured move off of this sell-off there to a previous high. So not really a great Fibonacci there. So I don't know why that changed colors, but I was going to remove that drawing. There we go. I put 2 on there. Sorry. Remove. There we go. I should put another drawing in there. As a matter of fact, why don't we just do that right now? Oh, it's not going to do it. Sorry, you guys. I wasn't set up for this. Let's just throw some Fibonacci's on there just to see where we're at. I'm not going to line it up perfectly, folks. I'm just going to get it quick and dirty just to see if there's anything to see there. There. Jeez. Everything. All right, so look at that. We throw up these Fibonacci's and look at that. We came down and just tagged that line. Something to note with these longer duration market profiles is these little nodes will act as an area where sometimes you'll hear the people talk about this with market profile, that it's a support area. It's really a magnet, folks, is the way I look at it. It's not a support and a support or a resistance necessarily, but it's a magnet where the market wants to come back down and consolidate those areas. So that is more of what I like to consider it as. The supports are just outside of those nodes there as the market starts to pick up some buying pressure. And I'll talk about that today. We're going to be talking about the webinar that I'm doing a guest spot for, and we're going to be really drilling down on this market profile there and even breaking it down into a daily pattern here where we can see the intraday supply and demand of the markets here. So talking about that, we can see that overnight inventory from the opening is well below that. So that is bearish heading into the open. I would not be surprised to see a slight, maybe half back to retrace some of these folks that got short, try and push them out a little bit. But I do not think we're going to probably see the value area high from yesterday. I think we're going to see a baby bounce here and start testing some of these lower levels going forward. The numbers just aren't there, folks. We're going to be hearing from folks out in Davos talking about the economy. I don't think anything's going to be coming out of that very good. So we're going to be seeing some probably pain in the markets going forward here a little bit. One thing, though, I wanted to talk about is I've always used IBM as an example as a great store of value and something that we can trade easily off of from a swing trade perspective, because it's easier for us to see sideways patterns. It takes more of a trained eye to see bullish and bearish patterns and trends, support and resistance levels there. But when we get it sideways, it seems a little bit easier, as you can see with this chart here of IBM. Now, we've seen it bounce off of these Fibonacci's. So I've left them up, despite the fact that some of them had bled through a little bit, if you will, but it's holding pretty strong that we can see these Fibonacci's are the levels that we would want to be participating in for this trade. So if you're looking for things that are in a bullish market, well, we've got IBM right here. I think EA Sports was another one that was in a bullish market, at least last week. Coming into this week, it's continued that as well. So heading back up to the point of control, like I said, those big nodes are magnets. It's drawing it to it. It's not necessarily a support and resistance. It's more of a magnet in my eyes. So that's about it. Please check it out at Pro Trader Strategies, the webinar we're doing tomorrow. We're going to be doing it on the risk reversal. If you're any concern about downside risk, we're going to show you how to mitigate some of that in that video. Also today, I'm going to be talking about the the market profile. So make sure you guys are subscribing. Smash the like button for me before you go. If you had a light bulb moment or anything else, share this content with somebody else by smashing that like button for me. And the bell will let you know when I'm unannounced. So check that out and you'll be in on all the videos that I do. All right. So if you can't take that, take it easy.